Okay, so the last thing we have to talk about in this chapter, oh wait, I think there's two more things, sorry. The adjusting and closing entry. So we're closing out the system. So everything that we did in chapter 3 and 4 with the adjusting and closing entries, that all still happens. We just have a couple little differences and one extra thing. So let's talk about that extra thing first. Even when you're using, so even with a perpetual inventory system, and we talked about the difference between the two. So even with a perpetual inventory, you still have to do a physical count from time to time, probably once a year. So still need to do a physical count. And if you've ever worked in retail, you probably know exactly what we're talking about here, because you use a perpetual inventory system. You scan the stuff in, you keep a running total of what you have in terms of inventory, but once a year you probably still have to do a physical inventory count. And this is because we have to quantify the inventory shrinkage, which is the disappearing stuff. Stuff gets damaged, stuff gets misplaced, stuff gets mishandled, stuff gets stolen, either shoplifting or employees. And so this stuff will, hopefully it's not large, but it's still going to happen. So at some point, your ledger account for merchandise inventory is going to be based on just what gets scanned in or out on that system. But some stuff is going to disappear that didn't get scanned out, and so we didn't account for that. And so that means the number that we're reporting as merchandise inventory is a little bit bigger because some of that stuff has disappeared that didn't get scanned out. So if we take the balance in the merchandise inventory account. This pen's driving me crazy. The balance in the merchandise inventory account, that's what's in our ledger account. And we subtract the actual merchandise inventory on hand. So what we get when we do a physical count. So this is the balance in merchandise inventory is what we should have. The actual merchandise is what we have. And so the difference between the two is going to be the amount of your adjusting entry. So any merchandiser is going to have to do this in addition to the other adjusting entries between. If you can see, this is a lot like we did with the supplies, right? We said, all right, here's what we bought, and then here's what's still here, and the difference is what went out. And so that's kind of what we're doing for the inventory shrinkage as well. The journal entry is very simple. We debit cost of goods sold and credit merchandise inventory for the amount of the difference. So if my records say my inventory count says I have 150,000 in inventory, and then I do a physical count and I've got 130,000, then that means the difference here of 20,000, that's the amount of my adjusting entry. So I debit cost of goods sold. I'm adding that to expense. Even though I didn't sell it, it's still an expense to me because this is just part of doing business. And I reduce merchandise inventory by that. So, for instance, here's my merchandise inventory. If I started with 150,000 and then I just credited 20,000, I'm left with 130,000, which now matches my physical count right here. And so I've brought that asset down to reflect what I truly have. And there are some places that will actually have a separate account for inventory shrinkage instead of just putting it to cost of goods sold. But ultimately, it is a cost of selling for you. So that's just kind of how we count that. The rest of the closing entries, so that we add that to the adjusting entries. The closing entries are all the same with a small couple differences. If we have that sales discount forwarded, that gets closed out with the sales revenue. So we close the revenue account and that discount forfeited to income summary. Then we still close all the expenses to income summary. We just have a new one here with the cost of goods sold and maybe the delivery expense. And then these last two are exactly the same as we were before. So the process is exactly the same. Close revenue to income summary, close the expenses to income summary, then close income summary to capital, and then close the withdrawals to capital. These are also expenses, so we're not doing anything different. The discounts forfeited would be the only new thing there, and we just treat that like a revenue because it is a revenue. So one problem here to do the inventory shrinkage adjusting entry. Gianna's Furniture has an unadjusted merchandise inventory of 69,000. The physical count came up with 67,600. Journalize the adjusting entry needed to account for the inventory shrinkage. So our books say we have 69,000 in here, but when we do a physical count, we only have 67,600. So 69,000 minus 67,600, that means we've had $1,400 worth of inventory that disappeared for whatever reason. And we'll talk in later chapters about how we try to minimize this and how we manage our inventory to protect this asset. But so all we do is debit cost of goods sold for $1,400, credit merchandise inventory for $1,400, and we're done. And that will bring the balance in the merchandise inventory account down to 67,600, which will match what I physically have. Then once we've done our adjusting entries, we can do our financial statements. So for this one here, they've kind of summarized things, and I do want to show you the income statement because it just has a couple differences. When we do the financial statements, this one is a closing entry one. Sorry, I'm not up to the journalize the closing entries. I should really read the problem, shouldn't I? So what we'll be closing here, we will close our revenue here, and we have interest revenue. We'll close those to income summary, and we don't even have that sales discounts forfeited, so we don't have to worry about that. Then we'll close our expenses to income summary. So our expenses are cost of goods sold, rent, is that it? Expense and rent. I don't even see any other expenses. And then we'll use that net income to get our new capital, and we'll close income summary to capital to add that net income. And then the last one we'll do here is we'll close the withdrawals to income summary as well. So the rest of these are assets and liabilities, so we will not need those for closing entries because those are permanent accounts. So here is here's the solution to that. It's probably more legible than if I did it. So we did the sales revenue and the interest to income summary. Then we closed we did have another expense. Where is it? Depreciation expense. There it is. So what did I say? That was blue. So there's our depreciation expense. So we close those three expenses here. Close those three to income summary. So now we've, if we're looking at our income summary account, and again, this is exactly what we did in chapter 4, nothing different here. But our income summary account, we would have credited it $650, $500, for our first closing entry. Then we debited it $411 for our second closing entry. And so right now it has a credit balance of $239.5. So we need to close that to capital. And so here we're closing that to capital, and then we close the withdrawals. So the ending balance in capital, if we look back at this one, we started with $198.1. So here's my starting balance. And then I credited it capital right here for the net income. Oops. Net income. And then I subtracted off the withdrawals, so the new balance in the capital count is $379.6. And that's the number that I would carry forward to the balance sheet. Okay, so speaking of balance sheets, when we do the financial statements for a merchandiser, the balance sheet, goodness, I just can't write. The balance sheet and the statement of owner's equity, there is no change. They are exactly like they were in chapters 1 through 4. The financial statement, though, will be a little bit different, and we've touched on this, but we will do a multi-step income statement. So it's still an income statement. It's still revenue and expenses. We just, as it's called a multi-step, we have a couple stopping points along the way rather than just revenue minus expenses. And so one of those is gross profit, which is net sales minus cost of goods sold. So net sales minus one of my expenses, cost of goods sold, gives me gross profit. Then I subtract off the operating expenses, which are generally grouped into selling and administrative. Selling is related to, again, this is a merchandiser, right? So this is anything related to, say, the store itself, the salespeople's salaries, delivery, advertising, that kind of stuff, and then admin will be like office stuff not directly related to selling. The other thing that's new is you will see a category for other income and expenses. These are things that are not related to my primary business. So expenses are revenues that are coming from sources other than whatever my main thing is. So if I'm running a bakery, these are, I'm running a bakery, but I also have a shed in the back that I rent out of storage space. So I get some rent revenue from renting out that shed, but that's not related to my bakery. Or I have to pay interest expenses, or I'm earning interest revenue on investments I have or something like that. That's still income coming in or expenses going out, but it's not actually related to my primary business, the store I'm running or whatever. So I want to track those separately because I want to be able to measure the performance of my business on its own, my store, separate from these other activities. So I put those in a separate category. So here is a multi-step income statement. Here we can see our gross profit. So net sales revenue, that'll be minus returns and all that kind of stuff and discount. So my net sales revenue minus my cost of goods sold gives me a gross profit. Then here you can see the operating expenses, and we have selling and we have administrative. So total operating expenses is the $269. So the gross profit minus total operating expenses gives me total operating income. That's how my business is doing, my store. Then I've got some other things. This is where that sales discounts forfeited shows up in the other income. And I'm counting interest expense here, so here's the total for the other. The expenses have parentheses. And so my total net income is $101,420. But my operating income, so how my business is doing, is $110,420. So we need to get to the bottom line, the net income, but I need these stops over here so I can see really what's going on and be informed and make the best decisions. So here's a problem where we're just kind of doing an income statement and then a statement of owner's equity and a balance sheet. So from here we'll just pick which ones go on which statement, and then I have the finished ones for you. So we know that revenue and expenses go on our income statement. So let's do income statement will be yellow. Okay, so income statement will be yellow. So I want, expenses go on that. Administrative expenses. Cost of goods sold is an expense. Remember, that's the only one we have that doesn't have expense in the name. I've got net sales revenue, and I've got interest expense. So those should be the things that are on my my income statement. Then I'll do the statement of owner's equity, and then the balance sheet will be next. So that'll have assets and liabilities. And there's a liability. It'll have capital, but we won't want that number, okay? Liability, asset, liability, asset. And so we want capital, but remember, we don't want this number, right? We need the new one that we'll calculate on the statement of owner's equity after we give them that net income. And again, here it says that there are no contributions or withdrawals. So it's just going to be the existing capital number. I shouldn't erase that. We need that. Need the new number, because we will still need that one. But on the balance sheet, we're going to put the new number. So here's the income statement. So we've got sales revenue minus cost of goods sold gives me a gross profit here. My selling and admin, so my total operating expenses are 14. So the gross profit minus the operating expenses gives me an operating income of 58,000, and minus an interest expense gives me a net income of 5735. All of these numbers just came off of the list they give me here. I haven't done anything. Haven't done anything here. It's just the ones that we highlighted in yellow. I'm going to take this number then, and I'm going to send that to the statement of owner's equity. So here's my statement of owner's equity, my beginning capital balance, plus the net income that we just calculated on the income statement. Gives me a new capital of 10,100. This is the one I want to use on my balance sheet. So here's my balance sheet. All of these numbers are coming straight off of the info they gave us in the problem, except for this one, right? This one comes from the statement of owner's equity that we just did. Everything else, so here's my current assets. Merchandise inventory is a current asset. So total current assets, fixed assets, total assets 16,700. Here's my current liabilities, my long-term liabilities. So total liabilities plus owner's equity. These two numbers right here, total assets equals total liabilities plus owner's equity. Everything's in balance, and we're all happy there. And then the last thing I want to show you is the ratio for this chapter, and that is the gross profit percentage, which is not too complicated. It's just the gross profit divided by net sales. And so again, that's sales after returns and discounts and all that kind of stuff. And so that's it. These two numbers are both coming from your income statement. So that doesn't really look like sales. What this tells us is it measures the ability to generate income, hopefully profit, from your inventory. It tells us how effectively we are managing our inventory. If you have stuff sitting around for a year before you sell it, you're probably going to have a very low gross profit percentage. And also it measures your markup. It's really how effectively you're managing your inventory, how good your markup is, adequate to your purpose. You know, if you mark it up too high, you're not going to sell stuff. If you mark it down too low, you're not earning as much profit as you can. So finding that right balance, that's what this gross profit tells us. So in this problem, we are, now they didn't give us the gross profit, right, but we have everything we need to figure it out. So we've got net sales and we've got cost of goods sold, and we don't even need the rest of these for this. So net sales revenue is 134.7 minus cost of goods sold, which is 114, gives us a gross profit of 20,700. So to find the gross profit percentage, which is what it's asking us, gross profit percentage is going to be 20,700, which is my gross profit, divided by 134.7, which is my net sales revenue, and I get 15.4%. Is that good or bad? We don't know. This doesn't tell us that. I mean, this is one of those numbers that doesn't mean anything until you compare it to something else. So compare it to your competitors, somebody in the same business. Gross profit's going to vary widely among retailers based on the type. A grocery store that has a really low profit margin but a high turnover is going to have a very different gross profit percentage than, say, a jewelry store or a mattress store, which has a really high markup but a low turnover. So it's going to vary widely. So you have to compare it to yourself over time. If your gross profit is going down over time, you'd want to know why. Compare it to your competitors to see how you're doing to them, but you really need to compare this number to something. But you do want the higher the better. So compare it to something to make this one meaningful, just like most of these ratios. And that is it for Chapter 5. Let me know if you have any questions.